In this session, we will be applying the concepts of fair value measurement IFRS 13 using some questions. The first question is related to principal and the most advantageous market. Now, Techno has business in two markets, USA and Europe. Required, discuss the measurement of fair value referring to principal and the most advantageous market. Details relating to the asset in the two markets are as follows. So you can see here that there are two markets, the USA and the Europe. The market price, transaction cost and transport costs are given to us. So assuming that USA is the principal market, USA is principal market. In this case, the fair value would be the market price minus the transport cost. You will not consider the transaction cost because transaction cost is a cost of entering into a transaction. It is not item specific. So in this case, the fair value would be 220 minus 20, the transport cost, that is fair value would be 200. Now to identify the most advantageous market. Now as per IFRS 13, the most advantageous market is a market which gives you the highest value, taking into consideration the transaction cost as well. So in this case, the USA, the value is 180. And in the European market, the value is 185 after considering the transaction cost here. Therefore, the European market will be considered as the most advantageous market. But the fair value 185 is not the fair value. The fair value here would be 225 market price minus the transaction cost, which will give you 195 as your fair value. So remember, the transaction cost is used to identify the advantageous market. It can be applied to identify the advantageous market, but for measurement of fair value, you will exclude the transaction cost. Going on to the next example, that is the highest and the best use. Now, Silver Ridge owns a piece of property which is currently used for industrial purpose. The fair value of the land for industrial purpose is 4 million. But many plots surrounding this are redeveloped into residential use. Silver Ridge land does not yet have the planning permission for the residential development. Similar nearby plots have successfully obtained it though. Fair value of Silver Ridge land as a vacant residential development site is 5 million. However, the transformation cost is 0.2 million. How would the fair value of the land be determined? So please understand the situation. If you use the land for manufacturing operations, the value is 4 million. But you convert it into residential, taking the required permissions, the value would go to 5 million. So if you are asked to discuss or guide how the fair value should be determined, in that case, land is not a financial asset. IFRS 13 states that the value of a non-financial asset should be based on the highest and the best use. The current use of the asset would suggest that the fair value be 4 million. But there is evidence that the market participants would redevelop the land for residential use. To redevelop it for residential use, it is possible to get the permissions. It is not legally prohibited. To get it converted into residential use, to get the permission, they are going to incur a cost of 0.2. Therefore, if used for the residential purpose, the fair value of the land would be 4.8 million. That is 5 million minus the cost to convert it into residential use. It would look as if the land's highest and the best use would be the residential purpose, and therefore the fair value would be 4.8 million. Going on to an exam style question. Falcon Limited owns several investment properties which it measures at fair value in accordance with IFRS 13. The pandemic has significantly affected the market prices. The directors of Falcon believe that the market is currently undervaluing the properties and have therefore decided to disregard the market prices. They argue that some of the market transactions are not representative as they involved sales that were forced due to vendors' cash flow issues. The directors have stated that they would not sell their properties under the current market conditions. There has been a notable decline in the number of transactions in the property market, but several properties comparable to those held by Falcon Limited were sold for the year end December 20XA. Now, with regards to the Falcon's financial statements for the year ended December 20X8, discuss the impact that the pandemic and the subsequent events will have on the fair value measurement of the investment property. So understand the situation. Falcon has many investment properties. They are valued in accordance with IFRS 13, but currently due to pandemic, the value of the properties have gone down. So they have said that some of the sales were forced because of cash crunch by the others, investors or vendors, and the directors of Falcon have decided not to sell these properties at such low pricing. Now, please note here that the requirement says discuss. It does not ask you how to measure the fair value. It has just asked you to discuss the various issues. So discuss the factors that will influence the fair value measurement. So you should start with IFRS 13 fair value measurement requires the fair value to reflect the price that would be received in an orderly transaction between market participants at the measurement date, that is the current market conditions. Now, due to pandemic, there has been uncertainty in the valuation and a wide range of possible estimates. Now, Falcon can use judgment to determine the most appropriate fair value in the circumstances, given circumstances. The fair value should be based in an orderly transaction and not forced sale as some of the vendors have done. If the transaction is clearly forced, it should not be given weightage. It should be given weight. However, Falcon needs to use its discretion or judgment to value these properties using level 2 observable inputs, because such properties, there were several properties which were also sold, right? And fair value is market based. So even if the directors decide not to sell the properties, they cannot value it at a higher rate. They have to follow the market based valuation. IFRS 13 has stated that the fair value measurement has to be market based and not entity specific. So while there has been a drop in the sales transactions, which may suggest that the market has become less active, this doesn't mean that it is inactive. And observable prices from the recent transactions, especially those which involve similar comparable properties, should be considered. So their relevance depends on the factors like type of property, location of the property. So if market data is limited, using other valuation methods like income approach might be appropriate. But in the recent transaction prices, level 2 inputs are available and they must be used instead of any unobservable inputs. So careful judgment is needed when evaluating the quality and the reliability of the market data. So your points covers all the factors that would influence, how they influence the fair value is what you should be writing and structuring your answer accordingly. Thank you so much.